Thank you for joining us today for a discussion on commercial real estate debt in the US, UK, and Europe. My name is Dhaval Parikh. I oversee product management and investor relations for our real estate debt platform. And I'm happy to be joined today by my colleagues. I have Bryan Donohoe, our co-head of US real estate, and I have Bill Moore, our head of European real estate debt. And so, Bryan, I'll start the discussion with you. Commercial real estate debt is obviously a very broad category. A high area of conviction for us in the current market are first lien mortgages. For those who are less familiar, can you please just define what are first lien mortgages?
Sure. I'll start with defining it from a risk perspective and payment priority, and then give some of the components of structure. First, from risk perspective, think about first lien mortgages as being first in line in terms of payment priority. So the safest part of the capital structure as it relates to a real estate asset. Structurally, the components of yield, right? So an investor in real estate that will receive income from a function of the base rate, so for LIBOR historically, the credit spread associated with that asset, as well as certain origination and exit fees. Generally think about these as floating rate with a change or a reset of that index monthly or quarterly, and relatively short duration. So the average tenor for these assets will be somewhere around 24 to 36 months.
In your view, what are some of the attractive attributes of the asset class?
Well, I think just thinking about a couple of Bryan's points there, your first lien in the capital structure, usually with a good equity cushion in front of you, high current income instrument, and it compares really favorably versus investment grade credit or core equity.
So turning our attention to the current market, clearly we've been in a tumultuous market environment over the past year. What's been the impact of commercial real estate debt? And specifically, what does the market opportunity look like today?
That's the fascinating question. And we haven't seen this kind of environment for over a decade. You've had this huge increase in base rate across the US and Europe. You've had an increase in credit spreads between 75 and 100 basis points on these types of assets. The total returns have increased 400 to 500 basis points. Add to that, you've had asset price volatility, and the impact of that has been to effectively push additional lenders out of this sector, and so reduce competition for the non-banks to gain even more market share than they've been able to get until now. So you're really seeing a very compelling environment for non-bank lenders.
Look, I think when you enter periods of illiquidity, as you're mentioning, Dhaval, those with capital have more of a say in terms of the transactions that will be consummated, and that holds true for commercial real estate debt today. Leverage is lower, so more equity, as Phil says, behind the transaction. Spreads are higher, and base rates are higher. Beyond that, from a legal perspective, in terms of the covenant packages that a lender can achieve on a given transaction, they're simply more sound than they've been over the past 5 years.
So, Bryan, for the next question, I'd like to talk about the scale of the opportunity. How big is the opportunity, and how long do you think it's going to persist?
Well, real estate represents one of the longest tenured and most significant asset classes for an investor to participate in. Think just notionally $5 trillion in the United States, $3 trillion throughout the European continent, the UK. We all interact with real estate in so many ways: how we live, how we work, how we recreate, and how we shop. And so we touch and feel these assets on a daily basis. When we think about the lending environment, think about that representing 50 to 60 to 70% of that denominator. The scale of the opportunity set is very large. And what we're seeing from a regulatory perspective, going back to the financial crisis, is the fact that the regulators no longer want the banks to be such a strong presence in the space. And you could say the same for insurance companies for the most part. And so what that represents is a shift of the allocation from these large financial institutions holding assets for a long duration to alternative lenders stepping into that void.
And Phil, what are the dynamics in Europe?
They're very similar to the US, but there are some key differences. And I think the biggest one is that we are, in terms of non-bank market share, way behind the US. So in the US, if you think there's about 50-50 split, it's a bit less from the non-banks, but it's around that number. In Europe, you're looking at 25% participation in the UK, and it's down to 10% on the continent. And as Bryan was alluding to, the regulators are really pushing the traditional banks to reduce their risk in this asset class. And in particular, this year, we're seeing the delayed implementation of Basel III finally come in. And that is expected to push the continent in the direction of the other markets. So we really think that the market share for non-banks will increase dramatically over the next 5 to 10 years. That creates this huge opportunity just given the size of the market.
So much of what alternative lenders do is pattern recognition, understanding where we're at in the cycle and how a consumer or a corporation or an asset's behavior will mimic what we've seen in prior cycles. Each has some unique attributes, but today, as Bill points out, we can look back to where the U.S. was following the financial crisis and expect certain similarities in terms of what regulations have as an impact to the lending community. And I think alternative lenders will benefit from that.
Yeah, and we saw the same thing in European corporate direct lending. 10 years ago, the stats would have been very similar to what we see today in real estate. You fast forward to today, non-banks in the corporate space are 50-50 with the banks.
Yeah, so Phil, maybe shifting our perspective to the borrowers. What are some of the top institutional borrowers looking for today in a counterparty?
I mean, the borrowers are still facing a lot of volatility in the market. And so, with their lenders, what they're looking for is for the lender to be there at the closing table with them. And so really the three things they want are certainty, and more certainty.
I think he's absolutely right. I think that underlying certainty comes from trust in your counterparty. That trust comes from having a like-minded approach to a given transaction. That means the market, the asset, the sponsorship, and that trust is going to come from having a similar mindset and the underlying having access to a scaled platform, the data, the information to inform that decision.
And so for our final question, we'll try to conclude and do this rapid fire style. 15 seconds, Bryan, why now for commercial real estate debt in the U.S.? And then Phil, I'll have you answer the same question.
Well, very simply, lower leverage, attachment points, higher spreads, higher base rates, and better credit protections.
And in Europe, I'll come back to what I said before. You add to that, we're going to increase our market share as non-banks, 2 to 4 times, depending on the markets. It's a huge opportunity.
Right. Well, thank you both. And thank you everyone for joining us today. If you'd like to learn more about the commercial real estate debt sector, we do have a white paper that's available on the Ares Management website. And as always, we would like to hear your comments. We'd like to get your questions. Please feel free to reach out via your Ares relationship manager. And thank you again.